Ladies and gentlemen, good day and welcome to the Q2 and H1 FY2026 earnings conference call of Nisus Limited, hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikhar from Go India Advisors LLP. Thank you and over to you.
Thank you and good evening everyone. We welcome you to Nisus Finance Services Co. Limited Q2 and H1 FY26 earnings Concall. We have with us on call today Mr. Amit Goenka, Chairman and Managing Director, Mrs. Mridula Goenka, Executive Director, Mr. Sunil Maheshwari, CFO, Mr. Amit Jhunjhunwala, CIO UAE Fund, Mr. Avdut Sarvate, CIO India Fund, Mr. Manish Meena, Director of Strategy and Corporate Affairs. I must remind you that the discussion on today's call may include certain forward-looking statements and must be viewed in conjunction with the risks that the company may face. I now request Mr. Goenka to take us to the company's business and financial highlights, subsequent to which we will open the floor for Q&A. Thank you and over to you, sir.
Thank you very much, Nikhar, for that. A very warm good afternoon to everyone. This is Amit Goenka, Chairman and Managing Director of your company, Nisus Finance Services Co. Limited, also called as NIFCO. It has been a pleasure and an honor to gain the trust of all of you today, and we are making all possible endeavors, given the significant tailwind behind us, to continue our trajectory and continue to do the best out of the opportunity set which is so vast in front of us. H1 and definitely FY26 in general continues to be a defining period for Nisus Finance. A period that is demonstrating our strategic acceleration and operational excellence. Following our IPO, which was landmarked by itself in December 24, we have transitioned to becoming a fully integrated cross-border urban infrastructure investment and operating platform, which is spanning to the fund management, advisory, and construction execution business. We've entered FY26 with a very strong momentum across every vertical. The first half itself, we have achieved consolidated revenues of 142 crores, which includes our acquisition of the construction company, the new Consolidated Construction Company Limited, a 78-year-old legacy organization with stellar credentials. However, the period of consolidation was only from 22nd August till end of September, and therefore does not capture the entire revenue of NPCL for this period. Even without the acquisition, our revenue growth remained in line with our outlook and our market opportunity, where revenues have risen 118% year-on-year to roughly 75 crore rupees, with Q2 revenue itself being up 61% sequentially, indicating our continued operating traction across our India and UAE GCC platforms. Our EBITDA has grown by 117% year-on-year to roughly 56 crores, with EBITDA margins being maintained over 76%, which has been a remarkable trajectory in line with what we expect from ourselves as an outlier performer. Our PAT stood at roughly 36.5 crores, which is up 94% year-on-year, with PAT margins being close to 50%, which reflect our scale, our efficiency, and our disciplined approach to our businesses, to the cost controls, as well as our capital deployment.
Excuse me, sir. I'm sorry to interrupt you, sir. Sir, your audio is not clear. May I request
you to use
your handset, please?
I am on my handset. Is it not clear?
Sir, may I request you to keep it a little bit farther and speak? Because your voice is muffled.
Okay, no problem. Okay. Is this better?
Yes, sir. You may continue.
Okay, thank you. Maybe I was too close to the speaker. Is this a better audio quality now?
Yes, sir. Much better. You may continue. Thank you so much, sir.
Okay. Thank you so much for that. Okay, just to very quickly say that even before the acquisition of and consolidation of new Consolidated Construction Company Limited, Our revenue growth has remained exceptional. Revenues have risen over 118% year-on-year to about 75 crore rupees, with quarter two revenues up 61% sequentially, indicating our continued operating traction across our India and UAE platforms. Our EBITDA growth of 117% year-on-year to stand at about 56 crores, with EBITDA margin of nearly 76%, reflects our discipline, our operating strength, as well as our alpha opportunities. Our PAT stands at roughly 26.5 crores, which is up 94% year-on-year, with PAT margins close to about 50%, which reflects our scale, efficiency, and our disciplined approach to investing as well as cost management. A key highlight of the period was, of course, our acquisition of India's foremost and oldest legacy construction powerhouse, New Consolidated Construction Company Limited, which has been obviously taken over at a fraction of its FY25 revenue, which stood at about 600 plus crores, representing a very deep value, high conviction entry. NCCL brings an active order book of nearly 2,350 crores across 30 plus high quality Grade A developer contracts, and is expected to scale to about 5,000 crores in the very short term. We've already repaid for part of the acquisition cost that we had borrowed, about 50 crores of the 110 crores that we've taken as a debt facility, and reducing the share pledge of the promoter and the chairman to only 18.5%, demonstrating prudent balance sheet management and cost controls. Importantly, during this period, Nisus has become the first AIF business and fund manager to receive a credit rating of BBB+ with Edge, which is in recognition of our governance, our credit quality, and institutional grade processes. This milestone positions Nisus uniquely amongst domestic AIF managers and reinforces investor confidence in our ability to deliver sustainable risk-adjusted returns. On the fund management side, today Nisus operates as a one-stop solution for real asset and urban asset infrastructure investments, offering specialized strategies that cover the entire real estate gamut of asset classes and the urban infrastructure supply chain. Internationally, our UAE and Dubai platform continues to perform strongly. Our recent acquisition of nearly 500 plus crores of an asset, which is at a deep discount to fair value or mark-to-market value, at a 30% rental discount, offers the potential to generate over 30% IRR for our LPs. Our regulatory approvals from the DIFC and as well as the ISDA authority, today Nisus stands among the first such Indian fund managers, investment managers to be licensed in the GCC outside of India, transforming us into a cross-border asset management franchise, connecting India's capital surplus, strong processes, governance, and product power with GCC's real estate demand and capital base. Our AUM of assets under management today stands at nearly 1,900 plus crores, having compounded at 95% CAGR since FY22. And we seem to be well on track to reach the 4,000 crore AUM outlook by the end of this financial year. The combined India and GCC pipeline, which is under active closure, today exceeds 4,600 crores, laying the groundwork for our next growth phase. In summary, H1 of FY26 performance has been to our satisfaction, in line with the acceleration of the opportunity set to become a full stack player within the urban investment space, both in India and the GCC. It has achieved, the half-year results have achieved or nearly crossed the annual numbers of last year, underscoring the velocity and resilience of our model. We remain focused on deepening institutional relationships, scaling our specialized funds, and maintaining our capital discipline as we continue to build one of India's most credible and globally connected urban infrastructure investment platforms. Thank you very much for the opportunity and the time afforded to me today to share our results and our excitement and enthusiasm about what is in store for us. Thank you.
Excuse me, sir. Should we open the floor for the Q&A?
Yes, we can.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Shashank Jha, an individual investor. Please go ahead.
Hi, sir. Congratulations for good set of numbers. Actually, it was very difficult to understand the result this time, but when I was able to do it, I was very happy to see the results. But I just wanted to know about the margins. Like, EBITDA margin was quite good, but it didn't reflect it in PAT. And was there some real estate impact?
So, Shashank, thank you very much for joining. So happy to hear from you. Have you seen the presentation which actually looks at Nisus Finance as a group company without...
Sir, your voice is very low.
With entity.
Is it happening to me or anybody?
Okay. I'm going to speak up again. Yes.
Yeah.
Shashank, can you hear me now?
Yes, I can.
Wonderful. Have you had a chance to look at a presentation where we've only shown Nisus Finance Group without consolidating NCCL? That will give you a very clear picture of our opportunity set. We continue to maintain a 74% EBITDA margin and nearly a 50% PAT margin on Nisus Finance Group. Obviously, when we consolidate the balance sheet and P&L of NCCL, which is a deep operating entity compared to a financial services platform, the blended margins will look slightly different. So which is the reason why we continue to present these two set of numbers, Nisus Finance Group on a continuing basis, comparing our history with our present, and with consolidating NCCL numbers.
Okay. Sir, like currently, like for
H1, we are having separately so that you have a very clear understanding of how both the engines are performing independently as well as jointly.
I will recheck it, sir. Also, sir, like we are done with 74 crore revenue in H1 only, and our guidance was between 120 to 150 crore. Are we going to achieve it?
I think that's the whole point of us having said that we are moving in line with our targets. We are moving in line with both our revenue targets, AUM targets, PAT targets. So we're certainly moving in that direction. Our endeavor is to continue to do better every quarter because the opportunity keeps on expanding for us both in India and UAE. So we feel quite confident about the growth and the future that is there for the next 2 quarters for us.
Great to hear that. Sir, one last question. It is regarding NCCL acquisition. So basically, when you say that you have got it very cheaply, so one thing I just curious to know, like what are you seeing in that particular business, which their owner is not able to see, or is there something else? Can you give?
No, there's no problem with that. It has been a very profitable company with cash profits and operating for the last 78 years as a phenomenal operator. It's one of the top 5, top 8 companies of India. The transition is happening purely for continuity purposes. The erstwhile chairman and one of the successor of the business, Mr. Abbas Azramwala, continues to be the chairman emeritus of the company. However, he's turned 91, and at that age, it will be difficult for him to be able to continue to steer the company into the next league of opportunities. He's done that for the past 70 years. He's led the company for the last 70 years, moving from a revenue of 50 crore rupees to a revenue of 650 crore rupees very rapidly. Now, obviously, at that age, it becomes difficult to continue, and it is important for somebody like us to step in, build the synergies, unlock the value that we have as a company, unlock the value that NCCL has as a company, building the synergies, create an acceleration for both of us, and that becomes an important milestone for us as well as for the founding shareholders, promoters, who obviously, given the age, are unable to continue operating it as usual.
Okay, sir, got it. But sir, my actual point is that if the business has that much potential, so how come you got it so cheaply? Like the owners of that particular company.
Well, that's a good point. That's a good point. So one is I've known the company for the last 15 to 18 years. Right?
Yeah.
They've done contracting work for our projects. We've known the management who today, as a promoter, Mr. Mahesh Mudda, who's the managing director and CEO with me. He's known to me as an elder brother for the last 20 years. And so for the promoter, it was not so much about value or valuation as it was about acceleration and continuity. So while they did have significantly better offers, to be honest, I think what the promoter really said is who's going to be able to build my legacy of my family as opposed to who's going to pay me the most. And I think that is where between Mr. Mahesh Mudha, who's been in the company for 40 years, and me, who's known the company for 20 years, we were able to find synergy with the promoter founders and therefore lock in a price that made sense for us.
Okay, great to hear that, sir. Thank you, sir. I will go back in the queue. Thank you.
Thank you.
Thank you. The next question is from the line of Vaibhav Lohia from CFM. Please go ahead.
And so thanks for the opportunity. So firstly, congratulations on the set of numbers, which was very unexpected, I think, for me as well, for the market as well. So I wanted to understand that.
What do you think was expected or not expected, Vaibhav? What did you say?
Not expected, sir, because usually in SME there's a lot of buzz around if there's a good result gonna be uploaded by the company.
Okay.
Yeah.
Well, I'm good to pleasantly surprise you then.
Yeah. So I can see a very big uptick in quarter two compared to quarter one as well. So like, where do you see quarter three and quarter four in only Nisus business, not the NCCL?
No, I understand that, and that's the right question, right? Because NCCL, of course, needs to build its trajectory along with us over the next 2 or 3 years. So looking at Nisus alone will make sense. Now, from quarter three and quarter four, like my previous participant asked, where do you see the outlook? I did maintain to see that we have significant tailwinds, we have very strong pipeline of investments. We're accelerating quarter on quarter. We're converting the UAE opportunity today. UAE forms only 30% of my revenue bucket, likely to go to 50% while accelerating faster because of the strong amount of investment pipeline that we're converting to investments very quickly because of the low base, huge capital demand, huge investment opportunity in the UAE from global investors. So I do see the acceleration of that happening every quarter. So I don't think that there's going to be any worry in terms of maintaining the momentum over the next 2 quarters or in the next few years, to be honest.
So do you want to revise your guidance? Like, because we have achieved more than 50% of your guidance in H1 itself, and being H2 week better, so like, do you see it exceeding as well for H2?
Maybe we will. I think the endeavor is not to get over-ambitious, but to be pragmatic about the opportunity set, because we still are in Trump economics. We still may face volatility from time to time because of changing stances, geopolitical nature, interest rate cuts, M1, M2 policies, etc., etc. So I don't want to get ahead of myself. I think we set a very ambitious target already, and I think keeping on track with that itself is ensuring that the 24/7, 365 at work. So I don't want to do. I think we're happy to achieve that. If God willing and with the graces of the elders, if we can do better, why not?
Okay, understood. And so, any light you can throw on FY27 if it is possible?
I'm sorry?
Any light you can throw on FY27 numbers, like where do you see your FY27 numbers at?
I think we put that $1 billion AUM mark already out for over the next 3 years, right? So I think we're accelerating in that direction for sure, and I think that's the target we would like to maintain.
Okay, understood. Thank you, sir.
Thank you.
Thank you. Participants, you may please press star and 1 to ask questions at this time. We'll take the next question from the line of Bhuvan MG from Tiger Assets. Please go ahead.
Hello, am I audible?
Yes,
you are.
Hello.
Yeah.
So thank you for the opportunity. So, sir, how are the Dubai and GIFT City platforms synergizing in practice? So, are we seeing any cross-city participation of feeder fund flows between India and GCC vehicles, sir?
I think we are, because there's always a cross-pollination between LPs looking at a suite of solutions from the same service provider, because LPs are backing an investment manager and not necessarily just one strategy. So we do see now, as we're accelerating in the UAE and getting new LPs, and those LPs are now starting taking very strong interest in our India investment thesis as well. So therefore we do see a very huge amount of synergies as more and more global capital comes to us for either of the strategies and then migrating to the other strategy very quickly.
Okay, yeah, that's nice to hear. So next, can you share your firm's strategy for tokenized and Web3 enabled real estate investments? So, are there any
UAE has
pilot
come up with
projects
a
under?
framework under the government of Dubai, wherein they have created a virtual assets regulatory authority called VARA, which officiates the entire tokenization business, which is very important from a regulatory standpoint to do any fractional business tokenization or digital assets. Most people have done it unregulated. But for the first time with the UAE government creating a regulatory platform, it creates a very unique opportunity. The market report of McKinsey, et cetera, puts the opportunity set at $5 trillion of assets, which are likely to get tokenized over the next few years. So that creates a very strong annuity for us. As we move forward in tokenizing and creating the licensing in our favor, we will be able to create annuities the way REIT managers work, right? So REIT is a regulated annuity portfolio for investors as well as the manager through a capital markets regulator, whereas tokenization is a similar product but in digital wallets, not in your demat accounts, but in digital wallets. It also creates annuities for the investor as well as the investment manager through these asset classes, but which is regulated by a parallel regulatory digital asset regulatory authority.
Okay, got it, sir. So next, couple more questions. So, sir, as you have guided that NCCL's order book will cross 5,000 crores in 1 to 2 years. So how can we see the composition between the residential versus institutional versus industrial? And can you also give the expected IRR of the individual segment?
There is no IRR. The construction is a margin business, right? So typically the industry works on 8 to 10% margins, EBITDA margins. Our companies have 9% EBITDA margins, which is in line with the largest players, being Ahluwalia, BA Kashyap, Capacity, etc. If you were to look at the numbers of those listed players, right? Now, when we are accelerating the order book to 5,000 crores, typically a third of that converts to revenue. Effectively, we're looking at 1,500 crores of top line as the order book goes to 5,000 with a 9 to 10% EBITDA margin. I think that's the important part, and so that's the first part. Second is in terms of composition of the order book, yes, residential has been almost 75% or 80% of the industry development or of the real estate development has been residential. But the company is very consciously, and gradually changing the profile of the order book by getting into data centers. It has been the largest constructor of pharmaceutical factories in India. It is looking to accelerate that capability in India, as well as industrial parks. It is looking at large-scale commercial. We built some of the most prominent campuses, including the Google campus and the Infosys campus, some of the most prominent educational institutes and hospitals. So it's clearly moving into its legacy asset direction and changing the margin. So the idea is to increase the operating margins of the order book and make it one of the top in the industry.
Okay. So you mentioned data centers. So has the company executed any data center projects, or is there anything in the
We are on the
pipeline?
way to data centers is a new phenomenon, as you know, started a couple of years ago. The company is on its way to secure some very prominent contracts to build some of the most prominent data centers in India. And these are high margin turnaround businesses.
So what are the margins that we can expect?
So typically, data centers, the residential EBITDA margins tend to be 9%. Data center margins tend to be 11 to 12% or more. With a shorter cycle time and less operating capital.
Okay. So one last question, if I can. So how much of the 1,000 crore India and 3,600 crore UAE pipeline is expected to convert within this financial year?
We've already given the AUM target for this year, so as a combination of two, we're looking to hit that AUM target.
Sorry, sir, your voice was not clear.
So we're at 1,900 odd crores. We should do another 2,100 crores between India and UAE.
Okay. Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Ashish Khandelwal, an individual investor. Please go ahead.
Hello. Am I audible?
Hi, Ashish.
May I request?
Yeah.
Also, before we go ahead, may I request all the participants who are questioning to the management to self-mute themselves when the management is speaking. Thank you. You may proceed, sir.
Sure. Congratulations, first of all, Amit sir, for the great set of number again. So my question is on the segmental reporting. So what we checked in Q1, you have 10 crore number from fund and advisory fund AUM business, and then this quarter, this increased to 45 crore. So this is around 35 crore increase, and our AUM increase only around 300 crore. So it's little bit odd. What's the extra amount that we have earned in this quarter into AUM revenue?
It's a good question. So we tend to believe that we will be able to maintain the ratio between advisory to asset management at 60/40. 60% being from advisory, 40% being from asset management. This quarter, this half year results show a slight amount of variance to that ratio because of sudden acquisitions of assets in this quarter, as well as revenues being booked from sale of our investments. So we invest concurrently into a lot of investments into our own book, right? Into the funds that we invest, into the companies that we invest, and we have sold these investments and exited some of these investments at a very high profit. Because of that, when profits are getting booked from sale of these investments at a high premium, because of the way the markets are, we are able to generate a very large exit revenue. So because of that, there's been this uptick in the revenue from investments. But otherwise, the outlook for ratio between advisory and AMC continues to be 60/40.
That is fine. So the advisory
execution.
Okay. Yes. You said so last quarter it was 10 crore, it was 35 crore. So I think you said there is a sale proceed. So some sales happen, and due to which you have the margin. So I think the unearned margin, you said 2% for the closure of proceed. Is that due to this, or I'm still not clear why? Because AUM is something.
You're right. So if you look at it again from a ratio perspective, our revenue to AUM ratio still continues to be close to 3.9%, right? Which is the guidance that we've also maintained, that we continue to earn very high ratios on AUM. So the AUM accelerates, we're able to continue to maintain that overall revenue percentage. Now, as a function of segment, some quarters tend to be very good in terms of advisory income, and some quarters tend to overperform in terms of the asset management, especially when there are exits and sale of investments. However, on a blended basis for the on an annual basis, the ratio 60/40 will still appear.
Sir, the current participant has got disconnected. We will move on to the next question, which is from the line of Abhinav Shetty from Ilios Financial Services. Please go ahead.
Am I audible, sir?
Yes, sir.
Congratulations, sir, on a great set of numbers. Sir, I had a few questions.
Thank
Sir,
you.
firstly, in the earlier call, you had given an AUM guidance of 4,000 crores, and right now it is roughly 1,900 crores. So, sir, are you on track to achieve that earlier guidance?
I just mentioned that given the strong pipeline of over 4,300 crores of conversion, we just need to be able to close 2,000 plus crores to be able to achieve our annual AUM target. So that doesn't look very difficult.
So, all right, sir. I probably missed it. Sir, I had another question that in this consolidated income statement without NCCL, the employee benefit expenses have increased by 89% from the first quarter to the second quarter. So any specific reason for that?
Sunil, can you please take that question? Our CFO can answer that. No worries. Sunil, are you there?
Can you hear me? Hello?
Yes, sir, we can hear you.
Yes, Sunil, please go ahead.
Yeah. So I was asking, are you comparing H2 versus H1 or Q2 versus Q2? So there is reason behind it. So we have employee strength has been increased to, you can say, to 50 employees. 50 employees from earlier 45 odd, and the ratio has increased in Dubai. So, and Dubai has a higher range of salary compared to India.
Okay, ma'am. So employee strength increased from 45 to 80, and there was higher salary in Dubai, right?
50.
50.
Employee strength increased to 50 and increase in terms of in Dubai employees, and where the salary range is higher compared to India.
All right, ma'am.
Yeah.
Also, I had another question that if the tokenization income will start from FY27, correct, sir?
Yes, that's the expectation.
Okay, sir. And one last question. Sir, if you could share the H1 revenue of NCCL.
Nikhil? We also have Mr. Mahesh Mudha, who's the Managing Director and CEO of NCCL on call with us. I request Mr. Mahesh Mudha and Mr. Nikhil Gupta to take the questions on our construction company, please.
Yeah. Yeah. So, do you require, the set of numbers, revenue guidelines?
What is the actual number for NCCL?
FY26 first half revenue numbers and margin of NCCL.
Yeah. So revenue is across 300 crores for the H1, and EBITDA is in the range of 10%, which is about 30 odd crores, and the PAT is.
Okay, Sunil, that's it. I think that's what we need.
Yeah.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Shruti Malpani from Earth's AIF. Please go ahead.
Hello, am I audible?
Yes, ma'am.
Yes, Shruti, welcome back. Always a pleasure to speak to you every quarter.
Yeah, thank you so much, sir, and congratulations for a great set of numbers.
Thank you, Shruti.
Yeah. So I just wanted to understand, did we restate our balance sheets for FY25 as well to reflect the NCCL acquisition?
Restate, so figures have been adopted of the NCCL in March 25, but not the restated ones. So they are following in there, and we are following IGAP. So there we have done the conversion to India's to IGAP.
Okay, so the March 25 results that were published in this one, now they're based on?
Just to clarify, we have acquired the company in mid of the August, about near to 24th August. So consolidated number is only for the 41 days, which is showing in the P&L. And the balance sheet is showing comparative number of NCCL and Nisus together.
If she's asking about FY25, have you restated FY25 numbers to also show consolidation? The answer is no, Shruti. We have not. We have not restated our FY25 numbers to reflect the consolidation as a batch process. We've only started consolidating it from.
Hello, sir. I'm so sorry. I cannot hear you properly.
Sorry, I'm just going to say this again, and correct me if I'm wrong, Sunil.
Yes, sir.
We have not restated FY25 numbers. We have only started to consolidate this company's numbers from 22nd August to 2025 for P&L and for P&L purposes. So what is going forward is a new set of consolidated numbers without restating historic numbers for our company.
Yes.
But sir, if we see the balance sheet for, the results that are published, and I was just checking on the figure for balance sheet, like long-term borrowings, I could see as 9.17 CR, which was earlier 1.17 CR. These are the numbers for FY25. So there's a 9 CR gap. So that's why have we, historically changed? Because I don't understand. So that there's a difference in long-term borrowings
Good
also
question.
and short-term loans and advances
You're
as well.
talking about FY25. Sorry.
Yeah.
So in FY25, previously published numbers and numbers published now, the long-term borrowing numbers look different. Is that the question?
Yes. Long-term borrowings and short-term loans and advances as well.
Okay. Sunil, can you please take that question?
Yeah. So this short-term borrowings we have restated from March figure to long-term, as the duration is now increased to more than 1 year. So that's why that has been restated for the March as well. You are right. Or for the 8 crores
The
of
total borrowing remaining the same.
I understand what Sunil sir said. Amit sir, you said something?
No. Please go ahead. That's fine.
Yeah, I guess Sunil sir was saying something.
Yeah, that was I was mentioning that has been restated from short to long.
So, as in, like, any specific reason behind that?
Yeah, so period has been increased. In March 25, that time it was below. It was management was expecting below 12 months, but now it is increased to 12 months, more than 12 months. So that's why we have restated for both the period.
Like, are we expecting any liquidity crunch and that's why we've increased the period, or?
No, nothing like that. Nothing like that. It is just that when we
Just for the accounting, no?
We take a term facility, we expect, let's say we take a 3-year term facility, but we want to, let's say, pay in 12 months. Now we said, let's convert cash and put it in growth. It's a low cost of debt, and therefore we can retain this capital for a slightly longer period of time, nothing more.
Okay. Now my second question is regarding the revenue, top line and bottom line. So with NCCL and without NCCL, so I was just checking the PDF, the pitch deck that you had shared. So without NCCL, Nisus's top line is 74.9 CR. So I was just calculating NCCL's contribution. So that comes down to around 66 CR approx. So
Correct.
And as for the PAT, so 36.5 CR is for Nisus and only 50 lakh is for NCCL, or am I mistaken here?
That is correct.
Okay, so that very low margins for NCCL's business, is that, so that comes out to around 0.6% PAT margin.
Roughly. Is that correct, Manish?
Yes. Yes, it is correct, sir. So we, as mentioned, it is near to 9% of EBITDA, and after tax it comes to around 1% only. So that's the reason.
Okay.
And just like my final question. To be very simple, we are in the process of unlocking value, right? So typically PAT margins in this industry tend to be between 3 to 5%. The company is at roughly, it has been at 3 to 5%. However, with the sudden expansion in the order book, it has taken on certain working capital limits and has been paying a certain interest cost for that. We're rationalizing that very quickly by unlocking almost 250 crore rupees worth of assets on the books and releasing that cash on the balance sheet, which will effectively kill the debt and translate the EBITDA margin of 9% to the PAT margin, which is higher than industry.
Okay. Understood. If the time permits, shall I ask another question or join back the queue?
Yeah, maybe you can come back so that we can take a few quick questions.
Sure.
Thank you. We'll take the next question from the line of Raj Gopal Ramanathan from Sadakush. Please go ahead.
Am I audible, sir? Hello?
Yes,
sir,
please.
your voice is low, sir.
Am I audible?
Your voice is low.
What should I do? I'm already on a headset.
No, that's okay. We can hear you. That's okay. You can go ahead.
Is it better now?
That's all right. Yes, please.
Please go ahead.
Yeah. So my questions might seem to be very, very basic because this is the first time. In fact, I've just happened to look at your company today, so I don't have much of an idea on what you do.
Wonderful.
But I had 2 or 3 questions, so I have nothing with respect to your recent financials, etc. 3 questions are: I happen to look at the credit rationale by CARE, and it mentions that you acquired this construction company from NCLT. Am I right?
That's wrong. It was acquired for promoters. NCLT had nothing to do with it. It's a solvent, healthy, profitable.
If you want, I can read out.
Okay, Nikhil. Sorry, Nikhil. Can you quickly look at that CARE rating and see whether they have erroneously mentioned NCLT anywhere? Because we will spot it in the report. But if you have, thank you very much. You will quickly look at it. That is not the case. We've effectively bought the promoter stake, infused more capital, and big.
Permit me to just read what is written there. NIFCO recently acquired NCCL through the NCLT process. The company confirmed that it has not extended corporate guarantees or financial support to this construction company and does not intend to do so.
The second statement is correct. The first statement is erroneous. Thank you for pointing it out.
Because, this is page number 3, of the credit rationale. Okay, fine.
Yes.
So you are confirming that this is
Nikhil, I would like you to read the full report, discuss this with the carriage rating, that they have known the company, because carriage has also been rating this company. Very strangely, they have given it BBB+ and now A- rating, and they have maintained this rating for this company for the last several years. So very strange that we should mention that, because the same rating company works for all my companies, including NCCL.
Okay. So as for you to take up,
which is why this company has the most efficient cost of borrowing compared to its peers in the industry, with very significant credit lines from all banks. So thank you for pointing out. And Nikhil, I want you to deeply read this report and ensure that they have not made any such stupid typo errors.
We'll get it corrected.
Yes. Fine. The reason is I wanted to understand a little more about this acquisition, and when I happened to read this rating rationale, that's where I happened to notice this. Okay. Now,
no, thank you for pointing it out. Yes.
So the second question is, I have not gone through the numbers of NCCL in detail, etc. So just for my understanding, you have acquired a 69% stake in this company. Am I right?
Yes.
So what is the investment that you are pumping into this company for a 69% stake?
So we put about 110 crore rupees into the company's bank account. We've put in a significant amount of, maybe 100 odd crore rupees plus or more into the account of the promoters to buy it out. So it's been a fairly significant amount of investment in terms of buying out the promoter and issuing new shares.
You completely bought out the promoters? There has to be a residual.
Yes, that is correct. That is correct.
You bought out the promoters?
Yes, I have. The promoters hold maybe 5% or so.
Okay.
So the promoters hold maybe 5%, but everything else has been bought out.
What is the net worth of this company?
Net worth of the company is what, 180, 200 crores? Can you, Nikhil, what is the number, Maheshji? Nikhil, are you there?
Yeah.
Give me the net worth of enterprise.
Yeah.
What is it? Post-money, so 200 plus crores? Give us 1 second. We're just looking at the September numbers.
Take your time, sir. Take your time.
140. So we, as on March, we are giving the number, or as of September?
March it was
September,
140.
what is the number? September, what is the number?
Yep. 1 second.
It would be 250, no? With 110 crore rupees of surplus plus internal accruals.
Yes, I mean, it should be around that, up to here.
Yes, Ajit.
Sorry?
No, go ahead. Please give me the number.
Yeah.
Okay.
Yeah, 225 crores as on September. It's 225. 225.
Okay.
Okay.
So the net worth is
225
225.
in September. And March 25, what was the net worth?
145.
150.
116.
Yes, 145.
145. Okay. So which probably means that you have infused around 80 crores into this company.
That is correct. That is correct.
Okay, fine. That is insofar as that is concerned. Okay. Now, what I wanted to understand is, what is your rationale for having acquired this company? Because somewhere I happened to see in your presentation that you have sort of indicated what's the expected growth outlook for this company. So are you sort of wanting to unlock value in this company in, say, 3-5 years' time? Is that the...
Without a doubt. Without a doubt. Yes, we're an investor. We're not the promoters. Promoters is the Mahesh Mudda. It's a management buyout. So today the management holds a significant equity in the company for over 26%. And he comes in as a promoter from the managing director of the company. Yes, the objective, like any, so, we've always said we've modeled ourselves around the global, private equity funds like Blackstone or Brookfield, where we invest into large value companies where we can unlock value in a very large multiple over the next couple of years. We're very well poised to do that because we're in the urban infrastructure space, which is exactly where this company operates. We deal with all the developers of commercial, residential, data centers, warehousing, industrial parks, etc., as investors and lenders. We're able to migrate those relationships very quickly to this company and help them increase the order book multifold times. We're able to work with various banks and increase the credit line as well as the borrowing costs very efficiently, which has happened in the last few months alone and continues to accelerate. And we're able to bring on our LP and our institutional relationships to them. And that is where the institutional financial platform behind a construction company, it is poised to be better than its peers, which do not have a similar advantage or leverage.
Okay. And you have funded this acquisition through debt?
Through debt and equity both, yes.
The
debt was only 110, which we've paid down to now about 50 odd crore rupees. We paid down 60 crores. The rest has been through sale of securities, which we sold at a profit, and internal accruals and my equity.
Okay, fair enough. Now, the second question, or rather the third question that I had was, when it comes to your venture debt and debt in real estate companies, are you sort of funding finished goods inventory of these real estate companies?
No, we are not. We do last mile, late stage completion capital. We don't do finished goods financing yet.
But is that an intent?
Could be. There are multiple funds on the launch.
Okay. So right now it's late stage financing. And so typically to understand late stage financing, are you talking about duration?
These are bridge capital which companies take at the last mile or the last quadrant of the development cycle, where they need to load in the regulatory FSI approvals, completed, exited in 18 to 24 months. So the cycle time of our loans or our investments tend to be 6 to 8 quarters therefore.
So you're talking about loans which would be having a duration or rather a tenor of around 2 years.
Yes.
Okay.
And that's right.
And this is debt. Okay. So how do you
That is correct.
How do you look at recognizing interest on these loans? Are they typically bullet loans?
That is in the fund. Interest comes to the fund. We earn a recurring fee.
Okay. Interest comes to the fund. You get a fee.
Yes. To the extent of the money that we've invested, we get. Yes, sorry.
No. Insofar as the cash realization of the interest is concerned, that would happen only when you exit the investment. Right?
No, it is a quarterly payout because these are completing assets and therefore there are collections every month which are swept in from the escrow account to pay the interest every month, every quarter.
Okay. So just to understand this a little better, I'm sorry if I'm belaboring this point. I'm sure you don't have something like an equated monthly installment construct here, right? So typically this would be what quarterly installments where you are realizing the interest and the principal payments come as and when, let's say, the apartments are getting sold or the liquidity comes into the company,
That's right. There's a schedule of repayment of the principal. That is correct.
So, just last point on this thing. With respect to principal repayments, let's say a 2-year loan, you tend to expect a back-ended realization of principal, right?
That's right. Usually there is a moratorium of 1 year on principal, no moratorium on interest. And principal repayment typically starts in the end of the 12th month or the 15th month, going to the end of 21st month to 24th month.
Fair enough. So, which means there is a moratorium of 1 year or so, right?
On principal, yes.
Okay, that's okay. Just to understand it, because that helps you to understand how it works. And sir, I happen to note one more point somewhere here. Did you have to pledge your shares for consummating this acquisition?
Yes, I did. I pledged almost about I pledged almost about 50% or 45% of my shares, and now it stands at 18.5% pledged.
Okay, fair enough. So I don't have any more questions because I obviously have to go through your company business model in greater detail. And I will come back to you if I have any further questions.
Most certainly. We are presenting very frequently at various platforms, so I hope you can join us the next time with more questions.
Thank you. Thank you very much. All the best.
Thank you. Thank you, sir. We'll take the next question from the line of Ankur Agarwal from Motorzack LLP. Please go ahead.
Hi, sir. I hope you're doing fine.
Absolutely. Thank you.
Sir, actually, I was looking at the consolidated balance sheet, and there are trade receivables of 303 crores, which is very alarming. Can you just tell us something about that?
That is to do with NCCL. You have to look at the balance sheet in two ways. One is our own Nisus finance balance sheet, right, which has hardly any trade receivables, and then there is the NCCL balance sheet, which is upon consolidation, because when you're doing a turnover of 600, 650, 700 crores, you will see receivables of 3 to 6 months, depending upon the aging of receivables and the cycle time of construction. So it does not relate directly to Nisus Finance's operations or to NCCL's operations.
Understood, sir. So the question that comes to my mind is that, let's say out of these 300 odd crores of receivables that NCCL has, what if, let's say some receivables are very long and even they are going bad?
It's an acquisition. We've done 12 months of due diligence. We've actually looked at every receivable. Whatever was not coming has already been written off last financial year. Okay, so all of the aging analysis is done. The credit check, the counterparty check of receivables has already been carried out. So they're all good, standard and receivable money. There is no delinquency expected at all.
And sir, by when can we expect to receive this?
I think we have a cycle of receivables, which will, as I said, we're unlocking almost 250 crores of cash on the balance sheet, which includes immovable assets, it includes movable assets of the company, it includes accelerating receivable collections, etc. So the endeavor is to bring back almost 250 crores of cash back on the balance sheet of the company in the next few quarters.
250 crores of cash, which is mentioned here as inventory, is that right? 248 CR?
Yes, some of it is inventory, some of it is receivables, yes.
And sir, one more observation I had was that trade payables is also very high of 183 CR.
The trade payables and receivables tend to work in tandem. If you extend the 3-month credit period to the client, our company also takes a 3-month credit period from the vendors. So the trade payables and trade receivable days tend to go in tandem. As the trade receivable days come down, the trade payable days will also come down.
Yeah, sir. So the root of the question was do you feel like NCCL is kind of over leveraged as an entity and
Not at all. Not at all. I think Manish and Maheshji, maybe you can quickly answer that question, because obviously that's something we already have researched and concluded on. in terms of leverage levels of NCCL and how low or how acceptable they are? Manish and Abdul, are you on there?
Manish, sir?
Ankur, can you hear me?
We can hear you now, sir.
Yeah. Ankur, nice to see you. Nice to see you on the call.
Same here, sir.
As Amit has already mentioned, we have gone through a rigorous 12-month due diligence process on the company. Not once but twice we have gone through each number, each entry. Okay. And there is no risk as such in terms of receivables as well as on the payable cycle.
Manish, just look at the debt numbers. You've answered the receivables, yes.
Yeah. On the question of the leverage, it's right now the company has significant growth potential. In fact, the leverage will only go up. That's the nature of the industry. And
so the long-term debt, Manish, the answer is the long-term debt is very low, right? What we have is working capital limits and bank guarantees.
It's only working capital.
Exactly. So what is the long-term debt? It's very small. So the debt to equity in long-term is hardly 0.1x or less. Right? Whereas the working capital and bank guarantees, how much is that?
7 CR. Long-term debt is 7 CR.
Therefore, the long-term debt on a balance sheet of 250 or 230 crore rupees is only 7 crores. What we have is working capital limits and bank guarantees, which we have debt. These are, of course, a function of the performance guarantees being provided and form a significant portion of the debt portion, as well as working capital limits, which keep on getting churned, which again is way within industry standards.
Understood, sir. And sir, if we talk about our standalone financial statement, so we did 45 odd crores in revenue. And may I know, how much was transaction advisory in this, and what is the visibility for transaction advisory business for next 2 quarters?
Wonderful question. So we've maintained that there will be a 60-40 ratio. Since the outlook of our top line, we know that almost 60% of that will continue to be transaction advisory this year, and 40% will come from asset management.
So, sir, we have this same kind of healthy pipeline in transaction advisory going forward into this year and next year?
Very large. Very large.
Understood, sir.
Hello.
Thank you.
Yeah. To your question on the debt equity, so currently ACCL has 0.68 actually. That is below 1. Yeah.
Oh, okay.
Yeah. So I think it's very much under control, and based on the industry standard, when the requirement is below 1, so I think we are good with that. Yeah.
Understood, sir. And sir, now when we are consolidating NCCL's revenue into our balance sheet, so since last 41 days since we formally acquired the company, so we are calculating the revenue for those 41 days and incorporating it in our balance sheet. Is that the case?
That is
the accounting standard specified on the consolidation. It's required to be consolidated P&L on the P&L based on your date of control, that was mid-August, and your balance sheet based on line-to-line consolidation in line with the accounting standard 21 year.
Understood. And sir, one last question, if I may. Do you see PAT margins for NCCL improving this year or next year?
I think the larger impact will be next year, because this year we are effectively unlocking balance sheet value, right? So as we are accelerating receivables, as we are monetizing our inventories and our fixed assets and releasing cash, and therefore reducing the incidence of depreciation and interest, the PAT margins will continue to accelerate, because the EBITDA margins are very healthy, above industry standards. So what I have to do is I have to just translate into PAT margins. So the real impact of PAT margins will really be seen in next financial year.
Understood, sir. And sir, very, very good performance and congrats to you. I'll get back in.
Thank you very much. Maheshji also wants to add something, but...
Yes, Maheshji, please. I think it's very important we bring Maheshji as a promoter and admin director of NCCL. I think he's best poised to give the exciting outlook for the company. Yes, Maheshji.
May I request the organizers to please unmute him so that he can speak?
Sir, I have unmuted him.
Hello?
Yes,
Yeah.
you're audible.
Yeah, thank you.
Maheshji, welcome to the call.
Yeah, thank you. And I think this question, whoever gentleman was asking, there is maybe a bit of a disconnect into his understanding. When we talk about receivable also, because that includes the retention money, which is the very peculiar of our industry. And this amount...
Very good point.
And this amount, because, if you see the receivable, because as Amitji rightly pointed out, in our industry, because minimum because credit, because you get into your steel, concrete and other material, 30 is the minimum, goes up to 90 days where because you can enjoy that credit facility. So likewise, even your clients also, they withhold your money because for the certification and then process, because it takes minimum, because you work for 1 month and then because next month takes the certification. So money relations start happening after 60 days. So this amount is very, very because justifiable in terms of our industry standards, and our receivables are good, duly verified, and because in the process of the due diligence, we also went very aggressively with all our clients because wherever some old outstandings were there, and because we have made them good. So going forward, because definitely because these numbers will increase by the way of because the turnover will also increase. So this is very peculiar of this industry. And about your question of because PAT increase, certainly because quarter on quarter as we go forward, because as the turnover increases, because our asset base is not going to be increasing in the same ratio. So automatically, because the depreciation amount will be lesser than what because today impacting to the balance sheet. So our EBITDA is very healthy, and EBITDA will be improved now because infusion of this money is going to help us very greatly, and which helping in fact to accelerate all our sites and achieve the required target turnover.
Thank you, sir, for the wonderful answer. Yeah.
Thank you.
And further to add Maheshji's point actually, so there is enough mobilization advance from customers. So DSO is also around the 60 days if you reduce that all the advances, mobilization advance. And the data is also good and realizable, so I think there is not much concern actually on the data.
Absolutely.
Yeah.
Absolutely.
Yeah.
Okay. Thank you. Next question, please.
Thank you. Yes, sir. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants in the conference, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Shruti Malpani from Earth AIF. Please go ahead.
Hello.
Yes, Shruti.
Yes, Shruti.
Yeah. Sir, I just wanted to understand how the H2 flow would be. So as in the presentation, so NCCL is expected to do 650 CR in top line, and as per the previous guidance, we can expect that Nisus does 120 to 140 CR. Correct. So do we expect a similar mix in H2 as well?
Sorry, can you repeat that? You're talking about the top line and the bottom line?
Yeah. So as a percentage split, in H1, NCCL had 48% of the revenue contribution, and the rest was by Nisus via transaction advisory and fund and asset management. Can we expect a similar mix in H2 as well?
H2 will be better because the numbers of NCCL in H2 are far stronger. After capital infusion, after accelerating the order book, the revenue numbers, because if you did 300 crore rupees of top line in the first half, and you're looking to do 350 crores in the second half, obviously the contribution will be better.
Okay. Further, we have consolidated for 41 days for NCCL for this H1. So,
that's right. That's not
the number would be higher than the Nisus for the H2.
Will be much higher. Much higher.
In the presentation, the number that is 650 CR of total income that is given, that is only Nisus's part of NCCL or NCCL's total income?
As a whole, not our part, as a whole.
Okay, and then it will be 69% for Nisus accordingly.
Yes.
Okay, thank you so much. That answers all my questions.
Thank you very much.
Ladies and gentlemen, we'll take that as the last question for today. I would now like to hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Manish, you want to put in a word?
Manish, sir, I would request you to kindly unmute yourself and speak.
Yeah. Hello.
Yes,
yeah,
sir.
we are
yes,
audible.
Yeah.
Can you please do the concluding remarks?
Yeah.
And I'd like to ask, Midla, are you there?
Thank you everyone for participating in this call and asking very pertinent, very important questions. Your continued support, your continued this kind of Q&A helps us on the vigilance, and we are very motivated. We trust that we have addressed all your queries during the session. However, if there are any remaining questions, please feel free to reach out to our investor relations team at Go India Advisors. Once again, we extend our gratitude to all for joining us today. Thank you and have a great day.
Thank you, members of the management. On behalf of Go India Advisors LLP, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming con calls.